What if we are repeating the same mistakes that led to the Great Depressions? We are living in an era of extreme wealth, inequality, stagnant wages, rising uncertainty, and if that sounds unfamiliar, it should. Because the year was 1929, and just like now, the signs were all there. The question is, are we paying attention? In the 1920s, the US experienced massive economic growth. The stock market was booming, credit was easy, and consumer confidence was sky high. Does this sound familiar? It should. Yes, there are echoes, overvalued stocks, speculative bubbles, rising debt. But this isn't 1929 all over again. Back then, there was no circuit breakers, no Federal Reserve safety nets, no instant global communication. Panic spread like wildfire. Today, tech stocks have surged, housing markets soared, and get-rich-quick investments like crypto have dominated headlines. But just like the 1920s, much of that wealth is concentrated in the hands of the very few. We saw euphoria before the fall. Now, we may be watching the sequel. In 1929, the richest 0.1% controlled nearly over 20% of the nation's wealth. Today, the top 1% control more than the bottom 90% combined. Just let that sink in for a minute. This level of inequality isn't just unfair, it's unsustainable, because when the majority of people can't afford to live, spend, or save, the whole economy becomes fragile. That's not just a social issue, it's a systemic risk. From the 1970s to today, worker productivity has gone up, but wages nearly flat. Meanwhile, rent, groceries, and education have all skyrocketed. In many cities, even a full-time job won't cover a one-bedroom apartment.
Bruh.
In the 1920s, the average worker also struggled while the stock market soared. We know how that ended, right? 70% of the US economy is consumer spending. But how can people spend when their real income is shrinking? Household debt is near record highs. Small businesses are closing faster than ever. And then there's inflation. Unpredictable and painful. It's not just about money anymore. It's about trust. And right now, trust in the economy is breaking down. Big companies are laying off employees, hoarding cash, and waiting. Why is that, you ask? Because even they don't know what's gonna come next. From geopolitical shocks to AI disruption to tightening credit, businesses are bracing for impact, not planning for growth. And in 1929, corporate leaders did the same until it was too late. After 1929, we got smarter. We built social safety nets, regulated banks, created protections. But over the last few decades, some of those protections have eroded. Mainly, deregulation, political gridlock, and short-term thinking have weakened our defenses. We have seen history before, but are we even learning from it? We are not predicting another Great Depression. What we are warning about is a cycle. Because when inequality grows and wages stagnate, people lose faith in the system, and then cracks widen. The good news, it's not too late to change course. Yes, there are echoes, overvalued stocks, speculative bubbles, rising debt. But this isn't 1929 all over again. Back then, there was no circuit breakers, no Federal Reserve safety nets, no instant global communication. Panic spread like wildfire. Better policies, stronger protections, fairer growth. Because this story doesn't have to end the way it did in 1929, but only if we act before the next chapter is written. History doesn't repeat itself, but it often rhymes, as Mark Twain would like to say. So smart investors, please continue to tune in before the music stops. Or is this just fear-mongering? Comment below. Like, subscribe, and hit the bell for more deep dives into this history economics in the future.